Well, good morning, Randy. We've got a great crew on the call. This is the first episode, if you want to call it, of the Aspen Real Estate Club, and I couldn't think of a better guest than Randy Gold with the Aspen Appraisal Group. We go back a lot of years, Randy, and I was trying to think this morning, how many years have you been doing the presentation to the Aspen Board of Realtors of the market dynamics?
You know, to be frank, I've lost track. I've, I want to say I've easily done 30, 35 presentations over the years. I did them initially with Scott Bowie, who was my partner for many, many years in our company, and then I did them with you for multiple years when you were kind of starting out in your real estate career, um, and then the last, I don't know, at least 10 years, 12 years, I've been one-man show. So yeah, it's been fun to do it.
And how far back does your real estate data for Aspen go?
So our company started in 1973. I started with the company in 1978, and we've got data as far back as 78.
That's amazing. So, coming up on 50 years in a couple of years, 50 years of data for the Aspen real estate market, which I have very good data going back 20 years. I moved back here 20 years ago, and that's really when also the MLS got much more robust, I think, right around 2005, of being able to track all kinds of things, not just sale prices. But to be able to have that kind of insight, I don't know anybody else here that does, that has the history and the level of knowledge you have with that far back of a look.
Yeah, I think that's fair. It speaks of longevity and also age. Um, I will say though that the early stats that we've got, I mean, probably not as well accurate in their own way, but different focus.
Sure.
And actually they really go back as far as 76 now that I'm thinking about it, because one of the graphs that I show at the realtor presentation just sort of marks number of transactions, and how that's changed because I thought that was always an interesting bellwether rather than any sort of dollar volume. It's just how many sales do we do each year of, houses and condos.
Of course.
So some of that stuff actually goes back to 76.
But let's remind ourselves there was a time when that's all that really mattered. People only cared
Yeah.
about how many sales there were a year. We weren't talking about price per square foot. We weren't talking about days on market. We weren't talking about all these other things that happen in the market now
Yeah.
that are important. But I think it's really cool to see how your reporting has evolved and just like I said, the history that's behind it that you're able to have that grounding. It was a really amazing thing for me to get to present with you when you were so kind to invite me to do that once a year with the Aspen Board of Realtors. And I think we did it for, I don't know, 4, 5, 6 years together before I was unceremoniously asked not to do it anymore because somehow I was getting an inside edge. I don't know what it was exactly, but
Well, I never really understood that whole
it was
thing, but
a great run
yeah,
together. Let's shift over because obviously the stats and everything behind the market is how you and I have gotten to connect a lot over the years, and I've really enjoyed that. But just on big picture, what is it that you enjoy most about being an appraiser, or being an appraiser in Aspen? You've done it for a long time and are clearly very good at it. I think many people, including myself, would say top appraiser in our area, our region, everything in terms of commercial, difficult properties, and maybe not doing the vanilla run of the mill that most people think about when they think of appraisals. You get involved in some pretty nitty gritty stuff. So, what is it that you love about it?
well, thanks for the kind words. I think the thing that I mean attracted me to the profession to begin with is I always had strong math skills, and I wanted to do something that was I've never really had the desire or personality to be involved in sales. And so I wanted to do something that was focused on real estate and was able to use my math skills, but also where the job changed a lot. And in Aspen, I'm fortunate because every property is different. I mean, it's also challenging because of that, but it also makes it much more interesting. And as time has gone on and my skills have evolved and the market has accelerated and the prices now are so crazy and we have such a different um, influence of wealth on Aspen real estate over the last 10 years or so, um, the process has become even more challenging. And and I really like that. I think that's sort of become my niche is to do the properties that are hard and the problems that are challenging. Um, a lot of appraisers don't want to do that. A lot of appraisers are not really capable of doing it. Um, and here every property is different, and that's really what makes it so interesting. And you get to deal with a lot of really smart people, and I like that. And so I get challenged in the work that I do in the product I put out, and then also the result of that product and having the the reader or the client, challenge me on some of my conclusions, and I like that. I think that part of things is fun. So that's
So it's
really the
like
attraction.
like a moth to the flame. You like the
Yeah.
challenge. I love it, and it reminds me of when this quote that just stuck with me forever. Henry Paulson, when he was the Treasury Secretary, and he was being just grilled by Congress at the time, and some problems that were happening with the government. And I happened to catch, and his response was, "All my life, I've been trained to run towards problems, not away, and that's what I'm doing." And so for you to say, yeah, there's sort of the cookie cutter approach, and I go back to when I was getting my real estate license, and you have to learn all these things to take the test, and you learn a little bit about the appraisal side of the business, and you learn about, okay, well, there's three approaches. There's the income approach, there's the replacement cost approach, and then there's the market cost approach, and appraisers use all three of those to value a property. I feel like you're so out of the box on that in terms of how you need to approach um, evaluating, and then providing value for property here. Can you talk a little bit about that? Are those three aspects that we all know or learn about applicable to you every day? Do you still follow that, or are you unorthodox in how you have to look at our market and the properties you deal with?
So at the end of the day, the appraiser's task is to mirror the market and put themselves in the shoes of buyers and sellers. That's the goal. And so what is important to buyers and sellers should be important to an appraiser. Um, so when you go back to the three traditional approaches, so the income approach, I mean, really, it's really never been relevant in the residential realm. It's become more interesting in the last 5 years as the whole Airbnb thing has kind of taken off and short-term rentals have been, much more of a driver for some purchases. But I still, from my experience, and my experience is informed a lot by talking to brokers every day and the people whose opinions I really value in the market. Those things are still, income is still really kind of on the periphery of most residential purchases. It may be a little bit more of a secondary driver now in how they think about something, but at the end of the day, I don't think that it is in it of itself the basis for value. So when you switch to the commercial realm, of course, it's all about income, and income is critical. And whether you're looking at an office condominium that is being bought by um, a user, they're thinking about income as well. If I don't buy this, I'm going to have to go out and rent a comparable office space. So what am I going to have to pay for that? And in looking at a multi-tenant building, the person who's buying that is looking for cash flow. I mean, 95% of the time, they might be looking also to uh, put their own business or presence in that particular building as an adjunct. But in most cases, I mean, they're really looking for cash flow. And so income's critical. Um, the cost approach, not relevant at all in commercial property, because it could be in a different market, but in our market, we don't really have land that you can go out and buy for commercial development. It's really, I mean, the core is all built out, and it's really the same in Snowmass. I mean, there's not much land you could buy there either for commercial development, and so there's not really a basis to help establish land value. And more importantly, buyers of commercial property, they don't really think about, well, I got the land in at $250 a square foot, and the building costs $1,500 a square foot, and so I'm going to pay $2,500. That's just not the way that their mind works. So the cost approach isn't relevant to commercial property. On the residential side, I think it is relevant. I still use it pretty much on every residential, not on condominiums, but on houses, every house that I do. And a lot of appraisers don't. A lot of appraisers now, particularly the ones that do a lot of bank work and a lot of form appraisal work, banks don't typically require the cost approach now. So I think a lot of appraisers have become lazy from that standpoint. And to me, if for no other reason, it's a really important check on what a property's worth. And I think, again, most buyers do go through that exercise mentally. It's like, okay, well, look, I'm thinking about this house in the West End, and I'm going to pay $5,000 a square foot for this house. I at least want to think about, well, is there another lot that I could go get? And yeah, I could go buy one for 10 million, and then I've got 2 years of approvals, and I got 3 years to build it, and I got $2,500 a square foot. It's worth it to me to pay $5,000 a square foot. Even if it's no more complicated than that, they've gone through that exercise often. And the brokers, I think, have gone through that exercise with a lot of their buyers of houses. And so to me, the cost approach is an important check on residential uh, property, particularly houses. For the sales comparison approach, I mean, that's key to all kinds of property because that really reflects the actions of buyers and sellers all the time. It's relevant to condos, it's relevant to houses, and it's relevant to commercial properties. More secondarily to commercial properties, but in the last 10 years, price per square foot's been a much bigger driver for commercial property acquisitions too, particularly office condos, retail condos, smaller commercial units rather than bigger buildings. So, yeah, sales comparison approach, super important to all types of property.
And I want to come back to that because the sales comparison approach, market approach, the way I think of it is probably the most straightforward. It's let's go out and look at what's sold at this same general price point or same similar size of this house or similar quality in a particular area. That can also be very challenging in a market like ours where you might have very few comps that have sold that fit that criteria. And so now you have to start expanding your search. But I want to go to the cost approach because that was uh, probably a discussion you and I had when I was early in my sales career that really stuck with me and has all the way to this day, and is probably the number one reason why you're my first guest on this series was you were so kind and took the time, but also talked to me in a way that uh, just I think I've never heard from anybody else, which is Andrew, something along these lines. Andrew, land is the basis for all valuations of property when we're talking about residential, especially in our market. And if you can determine for any property, whether it has something built on it or not, the fair value for that land, then you're ahead of the game because from a cost approach standpoint, now it's just a function of layering on top of that. So if I'm a realtor and I say, I need to go figure out for a new listing or for a buyer I'm working with, what is a property worth? Of course, I can do a comparative cost or a comparative sale approach. I can go look at what else is in the market, what's listed, what's sold, and come up with a general range that I think is fair. But if I'm able to add on to that this secondary analysis or this other type of analysis and say, let's also look at what's the land worth here? How many square feet have been built on here? What's the quality, the age, and what would it cost today? What would be the replacement cost today to replace this 5,000 square foot house? Well, interestingly, it's easily $2,000 a foot if you talk to a lot of contractors in Aspen right now as the starting point to build a new house in Aspen. So all of a sudden you've taken a piece of land that hasn't changed, size hasn't changed, attributes haven't changed, anything else. But what's really dynamic over time, at least has been in Aspen the last several years, is the construction cost. So I think about properties then, and I'm going to use a very extreme example or two, maybe two extreme examples. One is I think it was last year, Pickens County closed the open space, purchased the 800 something acre ranch out off of Snowmass Creek. Very difficult property, I would think, to appraise. I have no idea if you were involved in that at all, but a difficult property to appraise because it's one of one. What are you comparing that to that would be similar to that? Another example that I'll point to would be the $300 million listing that Mandy Walgos at our firm has, most expensive listing in America. How do you do a sales comparison approach when nothing here is ever sold for a little bit over $100 million? So how do you look at out of the box challenges like that when perhaps a market comparison approach is very challenging, but also I would think a cost analysis is hard too.
So it, it is uh, it is interesting to me, and this goes back to, I mean, really a lot of the residential um, appraisals that come across my desk that I see from other appraisers. I think one of the great weaknesses in a lot of residential appraising today is that they don't appreciate or really try to understand the importance of land in the appraisals that they're doing. And you'll remember me saying this, and I've said it at certainly more than one board presentation. When you think about, and this is particularly relevant to houses. Condos, it's a little subtler, but when you we all know the three most important words in real estate. It's location, location, location. You might as well say land value, land value, land value. And until you really understand that, I don't think that you can properly understand the value of the single family market in Aspen or really anywhere. But again, this is the only market I work. So I'll see a situation where um, an appraiser is appraising a house in the West End, and they'll pull comps from, you know, Mountain, or let's reverse it. They're appraising a house in Mountain Valley, and they'll pull comps from the West End or Red Mountain, and you're like, what are they doing? I mean, use comps like that, you can justify any sort of value conclusion. The land is so different, and land is really what drives the value. When you think about it, so not to get too far off on this, but a $10 million lot with a $5,000 house, excuse me, 5,000 square foot house, that's 2,000 bucks a square foot. And something sells for 5,000 a square foot, well, land is obviously a huge part of that. And so until you really understand relative land values, I think you're really short-circuiting the way that you analyze property. Sometimes it's really hard to understand land value. There may not be sales. And so then you look at what's called an extraction, where you might look at the last five sales in Mountain Valley, for example, and this one's a 1970s kind of house. What are they going to do with it? Well, they're going to tear it down. Okay, well, that's a pretty good indication of land value. Or no, they're not. They're going to keep it. They're going to totally remodel it. All right, so maybe the structure's got a couple $100 a square foot in value, and you would subtract that from the sale price, and what's left is the extracted land value. So you try to come at the land value, or at least I do. I try to come at it a lot of different ways. Getting into your question of, how do you approach the valuation of these one-off properties? It's hard. And I mean, I did have some involvement in the property in Snowmass Creek. Um, and it was a situation where, the data that you look at is large parcels, stuff in Wildcat Ranch, other big parcels in Snowmass Creek. I mean, McCabe Ranch had some stuff that was, some larger parcels. You look at what's listed, and then you try to be reasonable and you understand what can be done with this property and the pluses and minuses. I mean, it's a long way from town. It's surrounded by Forest Service, so even though it's about 600 acres, it might as well be 5,000 acres. But there's public access all the way through the property, drop dead views. Developing it with anything, forget it. The county would fight you at every turn. And so you really just try to do the best you can with data that is not very straightforward. Um, and in that particular case, the county had other motivations to buy the property. And so they were willing to pay a premium that clearly worked for the seller, and it also worked for the county, given their goals of taking care of this property and protecting it. So it kind of worked for both parties, but I think it was important for the county to at least start with what was sort of an objective and analytical approach to what the value was, and then they could decide, how much more they wanted to pay.
You
Um,
answered my question, but sorry to interrupt you. You answered my question perfectly, which is it's not always as scientific as we want it to be.
no.
Sometimes there's just other factors you have to look at and pull in some qualitative things as well to figure out how does that fit in. Never mind, okay, I have to find just the next best available, won't call them comps because they're not the same, but the next best available things I can use to value this. And I want to point to what I think is so valuable was for me as a real estate agent when I was representing clients. And again, you were some of the basis where this came from is any real estate agent can go plug into the MLS and do a CMA really easily. Any real estate agent can do that on their own without the MLS and just sort of go point to here are the sales in the market that I think subjectively or maybe more objectively compare to a property. But if you can get back to and say, uh, I need to strip back the improvements that are on the property and figure out the land. And so many times I remember doing that. For example, let's take the West End and saying, well, there are only 5 sales in the time period to go off. One was a land sale, 4 of them had homes. But if I understand the cost of construction, the replacement cost to build, I can extract that away and try to come up with 4 other land values that I can use. And now I layer on top of that my market knowledge that I have from contractors, from architects, from anybody else in the trades. What would it cost? What's it cost to go through the permit process? What's it cost to actually build the house? What's it cost to landscape the house, to do the interior finishes, all those kinds of things, and be able to come up with a conversation point that I feel like some real estate agents are very good at and some could improve upon, which is being able to speak to a buyer in particular, sometimes a seller, and say, yes, you're pointing to that comp that sold at 3,000 a foot and another comp that sold at 3,200 a foot. But the reality is it would cost you 5 million to buy this land today. It cost you 2,000 a foot to build on it. And so now you're at $4,800 a foot. This is a value. The replacement cost is so much higher. And being able to look at relative values based on that part of it, I think that's a really neat part of understanding a little bit of your world. And I want to shift and ask you, what do you see as the next opportunity in the market for you? What gets you excited, or what do you think where we're headed that might be a big shift? Because we've seen some big shifts over the last 5 or 6 years.
Um, So when you ask about, so what gets me excited, um, I guess what gets me excited is just the way things are always changing. And that's always been something that's excited me and been interesting to me. And particularly in a market that is dynamic, truly, I mean, we're a one of a kind place. I mean, I've been here a long time. I feel incredibly blessed to call Aspen my home, and I love this place in spite of all the changes. And yeah, you can always nitpick, and there's things that are, I don't love about what's changed, but change is inevitable, and that's all fine. I still think this is the best place on the planet, and obviously a lot of other people do too. So what excites me, I think what's interesting is going to be to see, there's massive changes coming to the Picken County Land Use Code, um, and how those are going to play out over the next 5 to 10 years, I think is going to be really interesting. So as you know, and I'm sure most of your brokers know, at least the ones that work up Valley, the county's changed the maximum size of a house to 9,250 square feet. It's going to be 8,750 outside of the urban growth boundary, probably as soon as that it's in the process of, they're writing code and passing a new comprehensive plan. That's sort of all in process. But that's going to happen over the next 12 to 18 months. So what's that going to do for houses that are larger than 10,000 square feet? And what it's going to do, and I think it's going to be interesting. And it was really one of the drivers of the whole growth commission that that I was part of this, community growth advisory committee um, that helped inform some of these land use decisions. The county is very focused on um, climate change and being responsible and getting to net zero by 2030 for new residential construction and all these other things. And so what it's going to do is one of the things it's going to do is it's going to inspire keeping a lot of these 10,000 to 15,000 square foot houses that would have been torn down immediately and rebuilt. And we've got lots of examples of that. Instead, they're not going to be able to rebuild that 15,000 square foot house now. And so they're going to keep it and they're going to work around it. And that plays right into what the county wanted to do. And it's a good thing, right? It's not going to be 15,000 square feet of stuff going to the dump. And so a lot more creative, I think, in some of the design issues. I mean, they'll gut it, but they'll do a lot to keep those houses and keep that square footage. So I'm interested to see how properties that have those bigger houses that are not going to be replicable anymore, how that influences value. So that's one of the things I'm interested in. I'm really interested in the whole TDR market and how that's going to change. Um, the TDR market has been one of the most fascinating things to watch over the last 5 years of any segment of the market. So, as you know, transferable development right in the county is 2,500 square feet of floor area. In the city, it's only 250 square feet of floor area. So, for years and years and years and years, the price was 250, 275,000 bucks for a city TDR or a county TDR. And it didn't matter that it was only 250 square feet in the city and 2,500 in the county. And buyers didn't really appreciate that difference. It was just that seemed like a reasonable price. By 2022, so the market in 2020, it just started to accelerate unbelievably. By 2022, the highest price ever paid for a county TDR was $2.5 million, which was insane because only 4 years before it was $275,000. And now, so that's in mid 2022. Now you can buy them all day long at 800,000.
Right.
So at 800,000, the price is about $350 a buildable foot of floor area. The city, the most recent sale is 675,000. So it's almost parity again, but that's almost $3,000 a buildable foot. I don't get that.
Right.
I don't really understand that gap. Was it all supply and demand? Was it because people in the county anticipated this big land use code change, and that's what drove all these buyers to pay $2.5 million or north of $2 million for a TDR? I mean, it's just been fascinating to watch. And now TDRs are going to get restructured into being only 500 square feet as the unit of measurement. So no one's going to be penalized. I mean, if you have 2,500 square foot TDR, you'll get five of them. But the need for TDRs is going to become more restrictive. You're going to need more to build less in the county, which will help the supply side or the demand side. And there's going to be on the supply side, there's going to be this whole nother level of TDRs that are created that are for long-term residents. Basically, you're going to be able to take a couple of TDRs from your own property, um, so that without getting, I don't want to talk too much about that, but it's a way to really um, I think, reward long-term residency because it's not easy to be a long-term resident here for a variety of reasons. The cost of living, being certainly one of the big drivers that drives people away. But I think the hope is that it will help keep a lot more long-term families, long-time families here with their kids instead of having to liquidate all their equity and then move to Grand Junction because one of the mom or dad gets sick and they need, $250,000 for medical bills, or they've got two kids that are going to college and each kid's going to cost them, 100 grand to go to college. How are we going to pay for that? This is going to be a way for them to get some equity out of their property and sell a 500 square foot TDR. They'll be able to sell two of them. And it's good for the county because it keeps these older folks and long-term families in the valley. It also preserves their old 1970s or 80s kind of houses longer than tearing them down. So it works on lots of levels. And I'm really sort of excited to see how that kind of plays out and how it influences the TDR market.
I love your passion for the TDR market. It's awesome. And by the way, if you and I could have predicted or anybody and said, where should I invest in Aspen real estate? Ironically, it wouldn't have been in dirt at all. It would have been in TDRs because they went up 10x in a very short period of time, much more than any other part of the real estate market. You've been very gracious with your time. I want to wrap up and just leave it with you and I, when we would do our presentations together, always talked about how we're not going to make any predictions. We're going to look in the past. We're going to talk about where the market's been. We're going to talk about where the market is today. And we're not going to make forecasts necessarily of where it's going to go, but the trend lines we can extrapolate out and say, here's where it could go. And you and I offline always have those conversations. I wish I could have forecasted the TDR market. That would have been a good one to know where it was going. Today, do you have any forecasts you want to share? Any predictions for the coming year?
I think it's really just going to be more of the same, which is not a bad thing. I mean, for us, I mean, really, sort of the thing that the trend that has been happening in the last several years is we're selling less stuff for more money. So there's less transactions, but dollar volume is the same or higher than it was previously. And that's because of the influence of these huge number of, single family sales that are over 20 million, 30 million, 40 million, and $50 million. In 2024, one out of every three sales in Aspen of a house was over $20 million. I mean, that's just insane. So in terms of predictions, I really think it's going to be more of the same. I don't see a lot of I don't see a lot of uh, pressure on um, appreciation. I think things are going to mostly stabilize. We're gonna continue to see sales in the 5,000 7,000 per square foot range, with a couple of oddities that may pierce 7,000. And we've had a couple sales at 8,000 a foot. Will we see a couple more? Maybe. Will Mandy be successful and blow everybody's mind at north of 200? Certainly likely. Um, and so I really think it's just going to be more of the same. Aspen is such a unique market. At the end of the day, we really don't have much supply, and we have the financial wherewithal of the people that own property here is really sort of unmatched in other areas. So the things that drive other markets don't really drive us, with the one caveat, and I've said this in many, many presentations, we never really know, but we are so tied to what happens in the stock market. If we go into recession later in sometime in 2026, and there's a lot of signals that that could happen. Doesn't mean it will, but if we do, based on history, people are going to pull back. Not because they really can't afford it. They're just going to, like, you know what? My stock portfolio just took a hit of $50 million, honey. I think we can maybe wait on that $50 million fifth house that we were going to buy in Aspen. On the other hand, there's going to be some people that are driven by the uncertainty and craziness in a recession and a stock market that's tanking, to put some more money into Aspen Real Estate because they know it's a solid market. It's a tangible asset that they can use and enjoy even when the market is not going so well in other areas. So that's the only real caveat for me, is what's happening in the stock market and the possibility of recession. Otherwise, I think it's going to be more of the same in 2026.
Cool. Thank you. It's a fascinating market for sure. It's a lot of fun to be a part of it in any respect. And it's cool to get a little bit of the inside glimpse from your perspective. You heard it here first, folks. The first 200 million plus sale, Randy thinks it's likely. Looking forward to seeing that hit the books. It's going to be certainly a headline grabber. Randy, thank you again. Have a great day. I look forward to catching up with you more soon.
All right, buddy.
Appreciate you.
All right. Thank you. Take
Take
care.
care.
All righty. Bye bye.